What if I told you that the stock market isn't as complex as it seems? I'm here to simplify everything so that you can confidently understand the basics and start investing. By the end of this video, you'll have a solid foundation on how the stock market works, why it's important, and how you can take the first steps towards becoming a successful investor. So let's start with the basics. What exactly is the stock market? Well, the stock market is a place where shares of companies are bought and sold. Think of it as a marketplace where people come together to trade ownership in businesses. These pieces of ownership are called stocks. When you buy a stock, you're purchasing a tiny slice of that company. The more stocks you own, the bigger your slice. So when the company does well, the value of that stock typically goes up. And if the company struggles, the stock's price will fall. It's important to note that the stock market is not just one place. It's made up of different exchanges like the New York Stock Exchange or the Nasdaq. But regardless of the exchange, they all function as markets for stocks. Now you might be wondering, why would a company sell its shares to the public? Companies go public and sell their shares to raise money. This process is called an IPO, or initial public offering. By selling shares, they can use the money for things like expanding the business, developing new products, or paying off debt. In return, investors buy shares, hoping that the company grows and becomes more valuable over time. Owning shares makes you a shareholder. As a shareholder, you have a claim on a portion of the company's profits, which can be paid through dividends. We'll touch on dividends a little bit later. But just now, it's a way some companies reward investors. Okay, now let's break down how the stock market works. Prices in the stock market are driven by supply and demand. When more people want to buy a stock, the price goes up. And when more people want to sell it, the price goes down. For example, if Apple releases a new product and people expect the company to make a lot of money, more people may want to buy Apple stock, driving up the price. On the flip side, if a company has bad news, like a product recall or poor earnings, investors might sell their shares, causing the price to drop. It's also essential to understand that stock prices fluctuate all the time. These price movements are called volatility. But over the long term, the stock market's history has rewarded investors who are patient and think long term. Now there are two main types of stocks: common stock and preferred stock. Common stock is what most people think of when they talk about stocks. As a common shareholder, you have the right to vote on certain company matters and receive dividends when the company pays them. Preferred stocks, on the other hand, typically doesn't come with voting rights, but preferred shareholders get priority when it comes to dividends. If the company has financial trouble, preferred shareholders are paid before common stockholders. It's essential to know that not all companies pay dividends. So if earning regular income is important to you, look for companies that consistently pay dividends. To get a sense of how the overall stock market is performing, we look at something called indexes. An index is a collection of stocks used to track the performance of a particular segment of the market. Some well-known stock market indexes include the S&P 500, which tracks 500 of the largest companies in the US, Dow Jones Industrial Average, which consists of 30 large, publicly owned companies, and the Nasdaq Composite, which includes over 3,000 companies, many in the technology sector. These indexes give investors a snapshot of the market's health. They help you gauge whether stocks are trending up or down overall. One thing every investor needs to understand is the balance between risk and reward. The stock market is known for providing excellent long-term returns, but it also comes with risks. The higher the potential return, usually the higher the potential risk. Stocks can be volatile in the short term, but over a long period of time, the market historically trends upwards. So while there is potential to make money, there's also the risk of losing it. Now that we've covered the basics, how do you actually start investing? Well, first up, you need to open a brokerage account. A brokerage is a platform that allows you to buy and sell stocks. Next, you need to research and choose your stocks. Take the time to research companies. Look at their financials, their history, and their potential future growth. Now, you don't need to know everything about the company, but having a basic understanding of a company's health is crucial for investing. And lastly, you need to diversify your portfolio. Don't put all of your eggs in one basket. It's best to spread your investments across different companies, industries, or even other asset classes to reduce your risk. There are two main strategies that you'll come across. There's growth investing and value investing. Growth investing focuses on companies expected to grow faster than the market. These are usually tech companies or companies innovating in their industries. Value investing focuses on companies that are undervalued by the market. You're looking for companies trading below what they're actually worth, in hopes they'll eventually correct and grow. Both of these strategies have their merits. Many investors use a mix of both. So there you have it. That's your introduction to the basics of the stock market. Remember, the key to success in the stock market is patience, education, and a long-term mindset. If you want to dive deeper into stock picking strategies or understanding market trends, be sure to check out my other videos. And as always, don't forget to like, subscribe, and hit the notification bell to stay updated on all my future content. Thanks for watching, and I'll see you in the next one.